when I was looking at those numbers, indeed, I thought to myself, that is a robust performance, absolutely, except for the dividend distribution, just a cent in it.
So thank you, and yes, you know, we're excited about the performance, but you know, on the dividend side, what we have done is that we have you know, stated a lower dividend for the first half of the year versus what we are targeting for the second half of the year. So we're very much still on track to distribute our 3 to 5% growth for the second half. We are working on quite a few initiatives on redevelopment of the portfolio, the existing portfolio. So we've got quite a few projects underway. So we've taken a more conservative approach and come out at a lower dividend for the first half, and we will definitely be on target to distribute what we have targeted out for the second half.
Okay, fair enough, fair enough. Let's talk about that performance, though. I mean, it does look very strong indeed, especially when you look around the African continent and Europe as well, and you see the kind of growth rates that we have had. Where did that come from?
So I think it's really around our investment strategy. So we want to be multi-geography, so we have investments into 7 countries, multi-asset class, so we're not overly exposed to any asset class, and then us dealing with multinational brands. So 92% of our portfolio is multinational tenants, so we let out to tenants of that nature. And we also collect over 95% of our revenue streams in a hard currency, and that being euros or dollars. So I think from our side, because we are servicing multinationals that deal with various sectors or economic drivers across some of these countries, you know, the macros of these countries, yes, they have an impact, but these tenants actually need to be across some of these African countries. So the performance is really based on being able to deliver sort of real estate platforms for some of these global tenants.
And you certainly have some of the best clients that one can wish for, the U.S. government. I'm sure nobody would worry about having the U.S. government as a client unless, of course, President Donald Trump is president and you get government shutdowns. Then you also have the Swiss embassy. I mean, so when you look at those clients, is it a deliberate strategy to get for the strongest clients you can get, or you just work with what you have?
So it's an absolute deliberate strategy. So, I mean, 93% of our tenants are multinational global guys like the American Embassy and Swiss Embassy. So, you know, we believe that when you're dealing with emerging markets and specifically Africa, it's quite important that that tenant base is quite secure. So we're trying to mitigate some of the Africa risk and some of the perceived Africa risk in these countries. And tenants like the American Embassy actually sign their lease out of the U.S. So even though they're sitting in Mozambique, we've mitigated a lot of that Mozambican risk. So it's an absolute deliberate strategy. And going forward, that's going to be our complete focus, is really pipeline around those multinational global guys.
Yeah, let's talk a little bit more about that strategy, because that strategy also says that you invest in countries that are rated by the credit rating agencies, and also you exclude South Africa. I was just trying to understand why you arrived at that strategy.
So, you know, we've always said sort of half the portfolio needs to be exposed into investment-grade Africa. And those are countries like Morocco, Mauritius, Mozambique, Morocco, Mauritius, and Botswana. South Africa for us is one, it's rand. So we are looking for hard currency, which is euros and dollars, and South Africa is obviously a rand economy. I think also the fact that the South African market is quite sophisticated from a real estate perspective. So there are over 30 listed REITs in South Africa. So we don't have a competitive edge like we do in some of the markets we operate outside of South Africa. So for us, we are looking for countries of growth. We're looking for countries of significant GDP growth. And that's why our focus is sort of that first mover advantage out of the SA market onto the balance of the continent.
Yeah. Quickly, Bronwyn, if you can, one of the numbers that struck me is the one around the portfolio weighted average lease expiry, WALE, you're calling it, of 6.5 years.
Yes.
And I was wondering whether you insist on that length or that's a function of the markets where you're operating. And I raise it because I know when I went to East Africa, for instance, one of the things that shocked me was being asked for my rental upfront for a year.
Yeah, so it's exactly. So I think it's quite different across the continent. I think, you know, our expectation is when we're signing with these global guys, and it's actually our retail portfolio that pulls that down. If you take that, our portfolio sits over 8-9 years on a WALE. I think our expectation is that we're looking for security of tenure, which gives us security of cash flow from these multi-global guys. So it's quite imperative that the long-term lease, we're sitting with a very highly occupied portfolio too, which is again, it's sustaining the cash flows, being able to distribute and pay out to our shareholders. So those are key investment strategies.
Absolutely. You're sitting on gold. Thank you. That's Bronwyn Knight, CEO and founder member of GREET.